Welcome to our video on how the stock market works. The stock market is a vital component of the global economy, providing companies with a way to raise capital and investors with opportunities to grow their wealth. In this video, we will explore the fundamentals of the stock market, how it operates, and the various factors that influence stock prices. What is the stock market? The stock market is a collection of exchanges and markets where stock shares of ownership in businesses are bought and sold. Major stock exchanges include the New York Stock Exchange, NASDAQ, and the London Stock Exchange. Companies use the stock market to raise funds for expansion and operations by selling shares to investors. Investors buy shares to gain ownership in the company and benefit from its growth and profitability. How does the stock market operate? The primary market is where new securities are created and sold for the first time. Companies issue new shares through initial public offerings (IPO) to raise capital. Investment banks typically underwrite these IPOs, helping set the initial price and selling shares to institutional and individual investors. The secondary market is where previously issued securities are traded among investors. Stock exchanges like the NYSE and NASDAQ facilitate these trades, providing a platform for buyers and sellers to interact. Prices in the secondary market are determined by supply and demand dynamics, buying and selling stocks. Brokerage accounts. To buy or sell stocks, an investor needs a brokerage account. Brokers act as intermediaries between investors and the stock exchanges. Investors can choose full-service brokers, which provide personalized advice and services, or discount brokers, which offer lower-cost trading options with minimal services. Placing orders. Investors can place different types of orders to buy or sell stocks. Market orders buy or sell immediately at the current market price. Limit orders set a specific price at which to buy or sell. Stop orders set a price trigger that converts the order to a market order once the trigger price is reached. Settlement. Once a trade is executed, it must be settled. Settlement typically occurs 2 business days after the trade date. During settlement, the buyer pays for the shares, and the seller delivers the shares to the buyer. Factors influencing stock prices. Company performance. A company's financial health, including revenue, profit margins, and growth prospects, significantly influences its stock price. Quarterly earnings reports provide critical information about a company's performance. Economic indicators. Economic conditions, such as GDP growth, unemployment rates, and inflation, affect investor sentiment and stock prices. Central bank policies, including interest rates and monetary policy, also play a crucial role. Market sentiment, or investor sentiment, or the overall attitude of investors toward the market, can drive stock prices up or down. News, geopolitical events, and market trends contribute to shifts in sentiment. Industry trends. Changes and innovations within specific industries can impact stock prices. For example, advancements in technology or shifts in consumer preferences can affect companies within those sectors. Global events. Events such as political instability, natural disasters, and pandemics can influence stock markets worldwide. Global interconnectedness means that events in one part of the world can affect markets elsewhere. The stock market is a complex but accessible avenue for companies to raise capital and for investors to grow their wealth. By understanding how the stock market operates and the factors that influence stock prices, you can make more informed investment decisions. Whether you're a beginner or an experienced investor, continuous learning and staying informed are key to navigating the ever-changing landscape of the stock market. Thank you for watching. If you found this video helpful, don't forget to like, subscribe, and leave a comment with your thoughts or questions. See you in the next video.